Hi, everyone. Welcome to another episode of Retire with Style. I'm Wade.
And I'm Alex.
And this week, we're going to continue our discussion of the safe withdrawal rate 4% rule style research, talking about what happens when you start to change some of the assumptions of the 4% rule. But before we get into that, we probably should have a little bit of small talk to start things off. So what's new with you, Alex?
Well, Wade, a lot. What are we coming off? Well, start of the school season, start of school. So, as always, I've got three boys, and two of them, I have twins that are 16, and they're driving to school this year for the first time. Yeah, right? Oh, wow is right. And so I was I was surprised by the new insurance rates that have come our way. And that's always a little bit of a sticker shock. And there it is. Youngest is in junior high, so we're all getting in the swing of things. Wade, do you think as a general rule I should wake up before my kids on a school day, or is it okay to sleep in a little bit and have them change and all that?
That's a good question. I wish I could stay asleep longer than the kids, but we have a nice system here where actually high school starts the latest, which is very different than when I was at that age.
Very good. Very good.
So that's the small talk. And we it's been a while since we recorded the last episode of this series. We've had some listener feedback that not everyone appreciates Alex's small talk. So maybe to keep the right compromise here, we should make sure to get into the thick of the matter at this point. But
yes.
Great insightful comments there, Alex.
Thank you, Wade.
And this is part of a series. So we're in the fourth episode talking about safe withdrawal rates. In the previous episode, we really talked about what William Bengen's SafeMax is all about, this idea of the 4% rule as a retirement spending guideline. That's really the starting point for the total return style and is going to be a lot of interest to the total return style. But of course, the systematic distributions from investments actually plays a role in every retirement income style. So it is an important issue for everyone. But we ended the last episode talking about what the assumptions of the 4% rule were. And we teased when you start changing those assumptions, there are some factors for why 4% would be too high as a quote unquote safe withdrawal rate. There are other factors or other reasons that would explain why the 4% rule might be too low. And it's probably going to take us at least 4 episodes to get through all of those. We're thinking here 2 episodes on why the 4% rule might be too high. But we'll start with that. The bad news first, right, Alex? And then we'll get to the good news with the later subsequent episodes about all that being said, why the 4% rule might in some cases even be too low, and why.
Although I'm sure we can pad this episode even more so if you want.
Make it 6 episodes. No. We'll go ahead and get started. And a few of the reasons about why it may be too high, we've already introduced in previous episodes. Alex likes to jump ahead with some of the analysis. And there was that big shocker in our previous episode where Alex surprised the world with his questioning that 67 rolling historical periods is really enough to be certain about anything. But that would definitely be one of the reasons why the 4% rule could be too high. We'll talk about that in this episode, as well as the general asset allocation issue that the 4% rule does assume you hold at least 50% stocks in retirement. And then also whether or not, and this was something Alex kind of, wait a second, that's a crazy assumption. Are retirees able to earn the indexed market returns on a consistent basis? If they underperform the markets, then naturally as well, that would be a reason why the 4% rule is too high.
And wait, it's not that,
through that list.
It's not that it's a crazy assumption. It's that crazy people are making that assumption.
Or it's assuming people are more rational than reality might suggest in some cases. And whether they stick to those assumptions themselves and all that fun stuff. But yeah, I guess the easiest one on the list to get started with this would be, it's a simple point. The 4% rule we talked about in the previous episode, initially it was 50 to 75% stocks in retirement. as that was teased out in more detail, it was really 35 to 80% stocks in retirement supported that historically 4% withdrawal rate. If you let the stock allocation get below about 35% stocks, there is no 4% rule in the historical data. If you had an all bond portfolio, you're looking at the 2.4% rule from the historical data. And so that's important, because I often, when I talk about this, there's kind of two separate discussions going on. If you look at target date funds, which is the default option for so many people in their tax qualified accounts, their 401ks or IRAs, it's rare to see a target date fund that would have more than 50% stocks post-retirement. It may be more common, but not universal, to see target date funds with more than 35% stocks post-retirement. Target date funds are all over the place, but they exist in a different world than this sort of SafeMax research.
So wait, why is that? Why would you think so? And what I'm getting at ultimately is the allocation that we're discussing here, the 50% or 30 all the way to 80, that's based on what a sustainable withdrawal rate can withstand, right? Can sustain. What do you feel? Well, not what do you feel. What are institutions doing? The creators of these target date funds, how are they coming with these allocations? Because they obviously aren't coming at it from the standpoint of what's a sustainable withdrawal strategy that a target date fund can sustain. They're coming at it from another angle. Your other world sort of statement.
Right. They are trying to find the lowest common denominator of, if the only thing you know about a person is their age, what's the most reasonable default for an asset allocation by age? They are based on economic theory, which is young people, most of their wealth is not yet in their investment portfolio. It's stored in their human capital. The idea that they have this lifetime future earnings, that as they go throughout their career, they will earn income, spend a portion of that, save a portion of that. And that income for many people tends to behave more like a bond than a stock. Like a tenured professor is a pure bond. Maybe a commission-based stockbroker, their salary might be more like a stock. But nonetheless, we often, as a default, think that people's salary would behave more like a bond. And therefore, when you're young, to balance things out, you have a higher stock allocation. As you age and approach retirement, you're converting your future income into current income into savings, and your human capital is translating into financial capital. And then as you approach retirement, your human capital starts to really decline and drop off to zero. I mean, technically, as you retire, you don't have human capital at that point unless you decide to return to work. And that's why with a target date fund, you then have a lower stock allocation as you get to the retirement date. Now, the question of what happens post-retirement wasn't necessarily part of the consideration. And there's two types of target date funds. There's to retirement and through retirement. If it's to retirement, they usually just kick you into some sort of fixed, balanced, but lower stock allocation post-retirement fund. If it's through retirement, they might continue to decrease your stock allocation as you get 10 years past the target date, 20 years past the target date, and so forth. But again, they are generally all over the place, but lower average stock allocations than the 4% rule calls for.
But the interesting piece here is, and this goes back to the stuff that we've been doing on the RISA, is that they're assuming effectively once you mind your human capital and now you're relying on your investment capital to cover your retirement income needs, it's still, and obviously there's other products that are out there, but they're assuming you still want effectively this total return piece to it. Hence, you're getting this piece, but they're kind of going halfway, right? They're doing it just the conservative piece. They're not thinking about sourcing retirement income differently than from a portfolio. They're still just doing it within the portfolio, but they want to kind of lock in the potential volatility, hence the extra bonds, the extra bond allocation. Mm-hmm. But
reducing volatility.
Yeah. But even then, it seems like there should be another step, especially for 2/3 of the folks. But that's neither here nor there, since we're discussing the total return arc, if you will. We're on the 4% sustainable withdrawal rate strategy thing. But it's amazing how, though, even though we're on this specific channel of discussion, I want folks to realize that there's other ways. We're just on this specific channel on total return, but there's other ways to transition into retirement than just creating a more conservative investment portfolio. But this is just why these target date funds do it. That's how they transition your human capital to investment capital, by locking in on the investment volatility on the bond side.
Yeah, another guideline you hear sometimes is the idea of age in bonds, where if you're 60 years old, you're 60% bonds or 40% stocks. If you're 70 years old, you're now 70% bonds, 30% stocks. And if you follow that kind of guideline as well, it's going to violate the 4% rule again, where you're supposed to invest more aggressively to get enough exposure to market upside to fund that higher level of spending than you would ultimately be able to get through a lower stock allocation that doesn't give you the upside exposure.
A couple of points that I think merit talking about. First off, that book, Wade, is when he says, are you a stock or are you a bond kind of thing? And when you're working, your human capital is a bond. Like, there's a great book by Moshe Milevsky, Are You a Stock or a Bond? And Wade, I think he uses that same example of you're a tenured professor in that book. Don't hold me to that, but I think. And it's an excellent book to kind of get you to conceptually think about what's happening in this transition of capital as you retire, because I think that really is a foundational concept that folks should grab onto. Another piece that I think is fascinating, and it's more, outside looking in. We've got a lot of questions that come in from readers. Right. Well, let me lay the foundation. You said effectively anywhere between 30% equity to 80% equity seems to work.
35%.
35% equity seems to work in all of these market environments, et cetera, right? Because you're taking these 67 years of rolling returns and the like. I think there's a lot of undue fuss from folks, especially the engineer types. And we have a whole mess of them that listen in, that effectively do something along the lines of, well, the PE is such and such, and so the CAPE ratio is such and such, or whatever, right? And I'm going to reduce my allocation, increase my allocation, reduce it, increase it, the equity piece of the allocation. And ultimately, I read this as, if you're going to buy into the sustainable withdrawal rate, and it's pretty clear that if you're within the range of 35 to 80, it should work out. It seems like a lot of wasted energy to mess around with allocations here or there based on forecasted expectations of the market. I don't know. What are your thoughts on that?
Yeah, I mean, that's a good point. And we talked about in the previous episode that within that range, it's the idea is the more aggressive you are, you're not creating more downside risk. You just have more upside potential. So you kind of think about the downside risk is not there. It's invest more aggressively for upside. But yeah, there's a whole broad range of asset allocations where you're pretty much having the same downside risk exposure. So yeah, I could see how people might overdo it when they start trying to fine tune too much the specific asset allocation that they use.
Yeah, I think the risk of making a mistake, which we'll get to later on, is probably greater than the risk of getting it spot on. There's a lot left to chance when you do that. And if you get it right, you think you're a genius, and that kind of sows the seeds for future failures, if you ask me, from that vantage point.
Mm-hmm. But yeah, that's just the idea of the 4% rule, I guess to summarize, assumes you do have this more aggressive stock allocation. And if you simply don't, if you are going through retirement with 20 or 30% stocks or even less, that's violating the assumptions of the 4% rule. You can't necessarily, even assuming you're comfortable using historical data for this conversation, there isn't a 4% rule with those types of asset allocations.
Wait, there's one more point, and this goes back to the allocation before we drop off that. It's interrelated. It's not directly related, but I think it bears mentioning, and that's the risk of your wealth. You're right. As you're working, it's okay. You're accumulating let it ride, be aggressive on the asset allocation side. But as you get near retirement, and we're focused on distribution, you want to cut off the volatility on the distribution so you get more in terms of fixed income. But there was another point that I've seen, and I think you had a chart once on it as well, where the magnitude of your wealth is so much greater, though, as you also get older, that sure, stocks may go down 10% or whatever, but a 10% drop when you're 65 nominally is much greater than a 10% drop when you're 30. Hence, another reason to kind of lock that down. It's not just for the consistency of the income, but it's also for the overall nominal value of your portfolio. It's that much more.
Mm-hmm. Yeah, it's that idea of the lifetime sequence of returns risk. And I've seen that it's called the portfolio size effect. And when it was first brought up as a concept by Michael Drew in Australia, he was using that as a way to say, you really can't afford to be more conservative with a target date fund as you approach retirement, because that is the one opportunity in your life that you could get outsized market returns. And so then it really just becomes a debate around, it's indeed the case. If the market goes up 30% when I only have a couple $1,000s invested, it's not really having a big impact on my life. If the market goes up 30% or alternatively goes down 30% when I'm at the peak levels of wealth just right around my retirement date, in absolute terms, it may have taken me 20 years before I saved the amount that I just lost in that one market drop, or potentially gained in one good market year. So you are more sensitive to the potential gains or losses of absolute wealth near that retirement date, where in a traditional life cycle, you do have more assets. Absolutely. Is there anything, is that what you were looking for there, Alex, before we go to the next topic?
No, I'm good.
You're good? Okay.
Actually, I have my notepad and it actually disappeared on me. I'm using one of those remarkable tablets and like turned off. And I was like, oh, okay, where did everything go?
Oh, you lost all your notes.
No, I'm good now.
Okay. So the next issue, why the 4% rule could be too high, is, and Alex really pointed this out in our previous episode, it's simply based on a short period of U.S. historical returns. And that might not really be sufficient to have a lot of confidence that we've seen the full range of potential market environments based on what's happened in the United States since 1926. The first study I did in this area was I had a global returns data set looking, it's now 20 different developed market countries going back to 1900, and looking at if Bill Bengen had been Italian, would he have come up with the 4% rule?
And would his name be Bill Bengen?
Bill Bengino.
Bill Bengen.
But no. I mean, in Italy, the 4% rule with this as close of asset allocation to 50-50. So 50% stocks, 50% short-term treasury bills, which is closer to intermediate term government bonds in terms of giving a better performance than long-term government bonds. But the 4% rule would have only worked 28% of the time in Italy. The safe max in Italy was 0.8%. And well, Italy is one of the countries that lost a world war in this data set, so they do get some extreme outcomes. But it's not just that. Sometimes people do say, oh, well, yeah, if you lose a world war, you have a lower withdrawal rate. But no, it's really a broad range of experiences. The US and Canada are really the only two countries where the 4% rule worked. It didn't work in the other 18 countries. And it can, in many cases, a coin flip. Like Australia had really good financial market returns in the 20th century. High stock returns, low inflation, everything else. But still, in that late 1960s, early 1970s stagflation period, the US made it through okay with 4%. In Australia, 3.2 was their safe max. So it's not at all obvious that, I mean, things, the thing about the US historical data is we've had market downturns, but they've tended to recover quickly, and oftentimes quicker than with other countries' financial market data. And there's no promise that that's always going to be the case. It could have just as easily have been that a market downturn did not recover quite as quickly, even though average returns could be quite high. But a broader range of experience that I calculated now with around the world the 4% rule would have worked 68% of the time, not the kind of 100% of the time that we expect in the US historical data.
I would say there's a lot of truth to this. And you can say, it may be too high because the data is limited, but it could be too low because the data is limited. To me, the data is limited means that it's hard to draw, hard, fast conclusions. Directionally, who knows, right? But to the point that you're kind of getting on now, where Italy didn't work out, and I don't know, Imperial Japan or whatnot worked out or not. I ultimately feel you can make the same argument about the U.S., right? If you're looking at it through the 20s and 30s, I think structurally the U.S. is like another country relative to what it is right now, relative to what it was in the 70s and the like, pre-gold standard, post-gold, that kind of stuff. So it is different altogether. And so I don't know, it's, even though you're looking at that you can break up the U.S. into certain segments and kind of recognize that each of these segments are inherently different than the other one as well. It's not one continuous kind of constant U.S. And I think what happens is you look at the U.S. now and you assume it's going to go like this going forward, but it'll change in the same way that it's changed previously. So it's hard to just draw these inferences just based on the historical data, whether the data is limited or not. I mean, that's just a directional bias that it could go either way, which, as we said earlier, I mean, just to backtrack, these are based on rolling return periods. And so if you go from, if you use 10-year rolling returns, year 1 through 10, and the next one is year 2 through 11, and the next one is year 3 to 12, there's a significant overlap in which each of those cycles are pretty much going to follow each other very, very closely. And so there's not really a lot of independence that you can infer from.
Yeah, and this does become a very emotional topic and can lead to a lot of accusations and everything else in terms of...
Emotional? How so? Well, I don't know.
Well, if your entire retirement depends on using the 4% rule and you're using a total return strategy, you kind of want to reassure yourself that this is going to work okay. And anyone who questions that may be motivated by some sort of...
like you can lie to yourself a lot more. You can like emotional like that. You could be living in some sort of dreamland. I don't know. I think what we're going to have too is we'll have a future episode where we'll have an actual advisor on board, because we're talking about this. And I think the 4% rule, these are good starting points. These are good kind of barometers, as you said, when I was kind of cracking on this. But in practical use, we'll talk about it when Brian's here, but in practical use, I don't see people doing this, by the letter.
Right. And that's always the case, that you can't actually use the 4% rule. If you have to pay taxes, you don't have constant inflation adjusted taxes. So you're not going to have the constant inflation adjusted spending. And there's so many other factors.
I think all we're trying to point out here is a lot of folks will say, hey, we're looking at the data since 1927 and doing these rolling returns, and and we're just looking at the US, and there's a whole world out there as well. All we're trying to say, it's not as concrete as what they make it out to be, because some there's always somebody that'll say, well, I looked at the data, 99% of the time it worked out, so you know what, that's good enough for me. I think that's somewhat specious in terms of how it's being presented. And that's all we're trying to say.
And I do think the international data has value. And so, like I mentioned, the 68% was the success rate historically around the world for 4%. If you wanted a withdrawal rate that could have worked 90% of the time around the world, you would have been cut down to 2.8%. And I think that's just valuable information for retirees to consider on a forward-looking basis. Now, a related issue there, although we don't necessarily have to get into it too much, is just in recent years, interest rates have been lower in the U.S. Stock market valuations have been higher. And if you have a concern that, with bonds, there's not any controversy about it. Low bond yields means lower bond returns, lower sustainable spending from bonds. The stock market, who knows? But the idea is, historically at least, higher valuations correlated with lower subsequent stock returns, which would correlate with lower sustainable spending from stocks. And that
But
might just be a consideration that, yeah, the data where we are right now is different than what the US historical data had
I,
as an experience.
I think this points out something that you mentioned in the last one that I want to make sure everyone appreciates because it's quite important. You could have relatively low interest rates, or on the flip side, you could be thinking, "Wow, interest rates are going up." You know what does that portend? You want to speak about pricing power here and inflation and how that could kind of help or hinder as well. Remember how you were talking, in the 20s, sure things were down, but that wasn't the lowest period in terms of 4%. It was actually in the 70s, and why that
Mm-hmm.
was. I think that's a really, really good point, Wade.
Mm-hmm. The stock market did really poorly in the Great Depression. So if you were leaning towards those higher than 80% stock allocations, you would have had a lower safe max. But bonds did fine because this is an inflation adjusted spending rule, which you kind of have to make sure to check the assumption. The basic assumption of the 4% rule is if there's deflation, you would actually lower your spending throughout retirement. And that's what happened with the Great Depression. The prices were dropping. The real return on bonds was quite reasonable during the Great Depression. And so a balanced portfolio of stocks and bonds wasn't what created the 4% rule. It wasn't the Great Depression. It was the 1960s, a period of higher market valuations, inflation, a couple of years, a few years there in the late 60s, and then especially 1973, 1974, big stock market downturns, just inflation eating away at the purchasing power of bonds and so forth. That's what led to the 4% rule. And that's a concern in 2022 with now, even if inflation, the market's still expected to not remain high for too long into the future, but it's raising the price level permanently for retirements. If inflation is 10% this year, 0% next year, still the price level for that retirement is 10% higher permanently for the rest of retirement. And that's creating strains and stress that the diversified portfolio, to provide that inflation adjusted spending, needs to provide that growth to keep ahead of the inflation experience.
No, I think that's important. I think the last piece of all of this in terms of the market related performance is, you take historical returns and you're there, but there's a place, and you see this a lot in the literature, of what are expected market returns. What's the risk premium going forward? Like, what's the difference between the stock market and the risk-free rate? What's the spread between them? That's known as the risk premium going forward. And then they back it into a stock market return expectation, as opposed to just looking at historical returns, saying that the stocks have returned whatever it has been over the last few years. Wade, you may want to. I'm curious as to your thoughts on the risk premium and how that plays into us, because there's a lot of research, at least when it comes to Monte Carlo expectations. When you're putting in your assumptions, how may future outcomes, how may future, what is the market? How do you sort of determine what a future potential expected return is, and are you sort of skirting the fine line between forecasting when you do that?
Mm-hmm. Yeah, that would be another one of these somewhat emotional topics. But if you base it on the historical numbers, that's where you just look at what was the historical average return on stocks and bonds. The difference of them gives you a risk premium. What I tend to do as a baseline is consider where interest rates are. So the fact that bond yields are lower today than the historical averages is going to lower my bond return assumption. But then
But
there's
when
so
you
much
say that,
uncertainty
when you
around
say that
stocks.
it's going to lower your bond return assumption, that's not necessarily a forecast. That's just, if you look at the 10-year return, that's what it is. That's the number. That's
Yeah,
not.
today's interest rates are
Yeah.
very good predictors of future bond returns.
Yeah, it's not like Wade's guessing here.
No.
In terms of that. So that's, even though he's looking in the future, it's just a stated number right now.
Mm-hmm. And then what I tend to do is add the historical risk premium to that. So that's for example, since 1926, the large cap U.S. stocks, the S&P 500, has outperformed U.S. government bonds by 6% a year on average. And so I would take that 6% number and add it to the interest rate to get an average stock return, which will be lower than the historical average stock return because it's 6% being added to a lower interest rate instead of to the higher average historical interest rate. And that's the basic way I usually approach developing assumptions around that.
And it could very well be the case that future outcomes are linked to that situation, as opposed to, the period that happened in 1926 through whatever, n plus 30.
Mm-hmm. Okay, so to keep things moving along, the next issue, and it actually has two different elements of it, so we might only do one of them in this episode, but it's retirees might underperform the index market returns. The 4% rule assumes you earn the index market returons with your investments, and
our listeners do. All of our listeners do. So I can.
Okay. Yeah.
Right.
Absolutely. But it involves rebalancing to potentially an aggressive stock allocation, investing in the underlying market indices, maybe with index funds that have very low expense ratios. And that's the assumption of the 4% rule. So there are a couple of issues that go on with why investors may underperform the market indices that we'd like to get into. And we'll just see how long it takes to get through all of that. But it's, of course, investments have expenses. And then it's the investor behavior issue. Do investors really rebalance annually right on cue to maintain the balanced asset allocation that's being assumed for their retirement income plan?
Yeah, I would say these are robotic strategies, and very rarely do you find them, implemented in a robotic fashion, because the reality is the day before you're going to rebalance, you're going to think, oh, well, let me not do it tomorrow because the market doesn't feel right to me, or something along those lines. I'm not saying everyone does that, but I think when it comes down to it, you're going to be fighting those demons to go against it. And, Wade, what does a 1% reduction in returns turns that 4% rule into roughly 3.5%, if you will?
Mm-hmm. Yeah, right around there. And that's, so if you kind of, what's being done here is you take the historical market returns and just annually subtract 1%. So if in a given year the market return was 13%, you would use 12% for that year. If the market return was negative 4%, you would use negative 5% for that year. And yeah, it's going to reduce the safe max by, around 11 to 12%. It's that 4% rule would become more like a 3.5% rule. And it's not, sometimes this is a confusing point. A 1% underperformance doesn't reduce the withdrawal rate by 1%. It's not that 4% becomes 3%, because 4% is constant inflation adjusted spending, but a 1% underperformance is a percentage of what's left. So as the portfolio depletes, the 1% underperformance becomes a smaller dollar value. And so it works out to be, it depends, when does the market downturn happen, earlier on or later on, but typically somewhere around 1% underperformance leads to a 0.5% reduction to the safe max or to the sustainable spending rate for any particular retirement year.
Yeah, so think about it. And we just talked about the administrative functioning of implementing the safe max, which you could think it's easy, and I'm sure quite a number of folks listening do that, but I would say more don't than do. And this is pure, a lot of it just has to do with investor how you are as an individual investor implementing. And like I said, the day before it has to be implemented, I think that's when you start having those hard conversations with yourself. And if you take what's happening right now, you start thinking, well, I want to see where inflation settles in before I even touch my portfolio. Hey, I want to see where, Russia just announced they're not selling gas to Europe, and this is going to have implications because they're going into this, winter is coming scenario, and who knows what's going to happen in Europe. So I'm just going to wait to see how that plays out before I touch my portfolio. And 6 months later, nothing happened, and here you are, you haven't done anything. And that's more common than not. And it's very hard to disabuse yourself from all of the stuff that's happening. And so it kind of leads to the next piece of why investors don't capture that return. And there's been quite a number of studies. One of Wade's colleagues Blanchett has done some work, but even
It's
Vanguard
been on the show.
yeah, he's been and a friend of the show has written about this, quite a bit, and he started a little branch, with regards to financial planning in terms of what value is being added here. And just having a sounding board to help you from that helps quite a bit. Wade, do you want to go into the Vanguard study?
Yeah. So Vanguard has a study called Advisors Alpha. And so when we talk about this 1% underperformance, you could interpret that as a investment management fee or an advisory fee, but that's not necessarily the whole story, because with the Vanguard Alpha study, for example, they're looking at, they're a huge financial firm with many people with accounts. They look at the accounts where there's an advisor helping to manage the account versus the do-it-yourself type of an account.
And I'd like to add there, Wade, Vanguard, I think it's safe to say most of their business is direct to consumers. So it doesn't, you can say it's not in their best interest to show how an advisor adds value. It's not in their best interest or against their best interest. They're somewhat neutral, I would think, with regards to where they're coming from.
Right. They do have some advisory services and things, but certainly historically, the do-it-yourself type investor is a major influence. But what they talk about how advisors in all can add more than 3% in net returns to the client. Now we talk about that can sound like marketing literature from an advisor saying, yeah, I can add up to 3% more returns. But specifically for what we're talking about right now, they identify behavioral coaching, that advisors or accounts with advisors, just through what appears to be better rebalancing and coaching and not panicking and not leaving the account or leaving the asset allocation behind after downturns and everything else, that behavioral coaching can add 1.5%. And so then it becomes a matter of, well, if I would have underperformed the market by 1.5%, but then I pay a 1% advisory fee, I'm still better off, and now net gain of 0.5% at that point. So it is something to think about in that regard.
And that's in isolation from the other stuff, though. That's in isolation from just the actual administrative implementation, which is, it does take time. I mean, that's not fair. It's not a lot of time, but it takes more, not time, but execution, the ability to execute on a timely manner.
Right. So there's that issue, but also it's just, there's a number of different studies that estimate that. There is one study out there that I think may exaggerate the number quite dramatically. And we'll talk about investors underperforming the market by 7 or 8%, depending on the year, some crazy number. But you can set that sort of thing aside. Still, there are a number of other studies that are consistently estimating somewhere in the ballpark of 1.5%. And so, again, if you're underperforming the market by 1.5% because you're not following this sort of assumption of the 4% rule, that would mean approximately your 4% becomes 3.25% just through this sort of behavioral kind of investing cycle that people often experience.
Now,
you might want to talk a little bit more about what is it that happens with investors? Why aren't they necessarily following the rebalance every year on cue to the 50 to 75%?
Yeah, no, it's a good point, Wade. No, this goes back to that sort of the rise of behavioral finance that we've alluded to a few episodes at the start of our podcast series, actually, when we're setting up the whole resale. But what we find here, and here there's been a lot of writing about this. I mean, Kahneman and Thaler, they're Nobel Prize winners just for talking about behavioral finance, that intersection between psychology and finance, and how it's kind of messy in the middle, really. There's a gentleman called Daniel Crosby who's out there making a great name for himself, sort of a psychologist like myself, and he's gotten into this financial field. And there was a speech I heard once, and it was actually fantastic. And he pointed out there's a few reasons, in his view, which I agree with, why we're not necessarily adapted for investing. And you have to think about our history, right? Humans have been around roughly for 300,000 years. And from that vantage point, we've been we've been very adapted for survival. We're great survivalists, if you will. Markets have only been around for, the modern markets have been around for, let's just say 100 years, to be kind, right? 300 years if you want to go back to tulips and the like. And what do you think we've been adapted for? Really, it's for survival. And there's because of that, we're just not very good investors. We're great at surviving out there, but not very good investors. And take the brain, for instance, and the development of our brain. If we had to, we make about, I think it's something like 35,000 decisions a day. Wait, did you like how I looked like I just came up with that number off the top of my head? Wait, didn't I look that up before?
Counting up your decisions.
Yeah. Wait, didn't I look that up before the podcast? Because we knew it was a lot, and but 35,000, that adds up to about 24 per minute. You're making 24 decisions per minute. And if you're out there in the savannah and you hear a noise in the brush, you run. You don't kind of think, could that be a mockingbird? Could that be Wade bringing me a branch? Could that be whatnot? No, you're just running. And then later you can ask questions because you're adapted. You hear noise, stimulus response, And I get the whole point of the gap between stimulus and response is your freedom and all that kind of stuff. But for right now, let's just keep it clean, right? And so your body needs to make these shortcuts. I mean, the brain is a miraculous thing. I think it's the real 2 and 20 rule, in which brain makes up 2% of your body weight, but takes up 20% of the energy. Think about the you talk about the grid, the California grid. Think about the brain and its impact on the resources that it's taking from you. And so from that vantage point, to survive alone, you've needed to take shortcuts. And those shortcuts manifest themselves with heuristics, with biases that you start with. And those biases, again, great for surviving, not very good for investing. Just to take a couple, because there's plenty of podcasts that you go through a litany list of these, but the affinity bias, right? And this podcast, to some extent, is that you're listening to us, and our numbers are actually going up every month, every episode they go up. Right, Wade? Thank goodness. But no, right. Regardless of my chit chat,
as well as listener feedback.
yes. No. Our podcast numbers are going up, right? Wade could say it in spite, but no, they're going up. And what's happening is over time, you folks are getting to know us, and it doesn't matter if you like us or not. It's just the fact that you're listening to us and that we're getting that exposure, that familiarity breeds confidence. And that's something that's helpful, again, for survival. Hey, I'm going to listen to this guy. This guy's been around for 10 years. He must be living. He's obviously not dying. He's doing something right. That kind of thing. Unfortunately, with investing, I've been watching Power Lunch. Like on a day, when I work from my house, I do it. Not because on CNBC, not because I really care what they're saying. It's just passing the time, current events, that kind of thing. And I'm listening to these people, and I catch myself over time listening to them thinking, oh, okay, makes sense. But then I have to realize these guys don't know what they're talking about, But part of the reason why I'm fighting is that familiarity. I see these guys on TV every time, and after a while, they feel good. I think that's something we have to be cognizant of. It's hard to fight against it, but it's something we have to be cognizant of. Survivorship bias. You remember the winners and forget the losers. Go back to CNBC, right? What are there? I'm making it up, but let's say there are 8,000 mutual funds, right? A certain number are going to outperform by pure chance alone, right? And so there's 365 days in the year. I'm sure they could bring in 2 mutual fund managers a day that have outperformed the markets for 5 years and talk to you about their strategy. And if you're listening, you're going to think, oh, wow, this guy knows what he's doing. Or a woman, this person knows what he's doing. The reality is you would expect there to be winners, but they don't roll in the folks that have underperformed, right? You just remember the winners and you forget the losers. And that's a problem. It's no different than if I were to, I'm on the 3rd story floor and 500 of us decide to jump off, right? Not all of us will die. Most of us probably will. I know this is morbid, but bear with me for the example. For the ones that survive, you don't kind of look at them and think, whoa, how did they jump? They're geniuses. I want to jump just like them. No, you don't do that. because you want to survive. But when it comes to investing, we don't make that same, we don't use that same kind of logic. So these are shortcuts that we take. Hindsight bias. When you begin to reassess certain things, it's easy to play armchair quarterback and see how things failed. And then you convince yourself, oh, I see why this happened. I should have known. And then you think next time you're going to be able to recognize those items and make those changes. Doesn't happen. I could go on. There's a bunch of these things, but the bottom line is, listen, as human beings, these are very good adaptations for us to survive, but not necessarily to thrive when it comes to investing. And to read a book about the 4% rule and think you're going to implement it cleanly just because you understand it, you're overestimating your abilities, which is another bias in and of itself, overconfidence. You really are, when it comes to that. The other piece, the other piece that we have is we're social beings. And this was a good point. I mean, the example that Daniel gave was, you put myself and a monkey in an island and you come back a year, the monkey's probably alive and I'm not, right? Now, you put 10 monkeys and 10 humans in an island, most likely the humans will be alive and the monkeys are in a cage or whatever, that kind of thing. We're social beings and we work well within that manner. So think about herding, think about markets and oh my God, everyone's in, everyone's out. I got to get out of the market. I got to get in the market because look what everyone else is doing. There's this sort of sense that it's just maladaptive when it comes to investing to really be able to adjust that. Now, why? Look, we have an advisory firm and yes, it's always in our best interest to say that. But Wade, when I say that phrase, how do I end it? It's in my best interest to say this, but
it behooves me to say this, but that's nonetheless still true.
It's true, right? I mean, and look, I do whatever you want, but the reality is, I think the benefit of an advisor from all of this, it's not that he's gonna. Coaching is a funny term. I don't like behavior coaching from the standpoint of we're gonna coach you up, and all of a sudden you're gonna fight these biases and you're going to develop this superhuman strength to be able to conquer them. No, I don't think that's the case because advisors can't get over them. I think what happens is advisors provide a framework, a very systematic framework, at least the good ones, provide a framework that take your situation into account and inject it into a framework that helps you make the right decisions, and it begins to automate the process. Ultimately, that's the value of an advisor. And that's the value of even the 4% rule. It's kind of a framework. You still have to implement it. And that's where I think a professional helps in that. It's no magic dust that they sprinkle on you. It's just they give you a framework in which you can make good financial decisions on, and they help you through that process. Wade?
Yeah. And so again, it just in the context of the 4% rule, humans are kind of adapted to run away from danger. And the 4% rule doesn't assume that you run away from danger, which in the context here is in 2022, markets are down. Did you stay the course and rebalance to your aggressive asset allocation, or did you abandon your asset allocation? The 4% rule does not assume anyone's abandoning their asset allocations. And so that's just another consideration. If that's not the right assumption, then the 4% rule might really be higher than it should be in that context. We are getting pretty far into the time on this episode.
Wade and I were discussing beforehand. Maybe we can get 20 to 30 minutes out of this one, and we'll turn it into 2. And we're touching 50 minutes, Wade. Oh my goodness.
Yeah, so let's save the other reasons why the 4% rule might be too high for the next episode, and that'll be a great cliffhanger to tune in next time.
All right, everyone. Take care.
Yeah, thanks, everyone.